Hello and welcome to our latest Insider interview. Today in the studio I have with me Stephen Lilley, Fund Manager of Greencoat UK Wind. Stephen, thanks for coming in today.
Very welcome.
So Greencoat UK Wind, as the name suggests, you invest in UK wind farm assets. Could you summarise the main attractions of this area of renewable energy infrastructure?
In general, people that live in the UK understand that it is actually quite a windy place. The most important thing is actually the regime in this country, not just the wind volume, but is very stable. And also one of the great things about the regulatory regime that we operate in is that a lot of the income that we get is inflation linked. So coming into this point in time, actually having inflation protection of a dividend that we've now done 10 times, but also being able to preserve capital on a real basis, i.e. with inflation as well, is I think is a key attraction to investors. And then on top of that, you know, the UK wind market is a £100 billion market. We have £5.5 billion worth of £100 billion market. So we're almost in the FTSE 100 and we own 6% of the UK wind market. So it's a very big market. And that's likely to increase by another 100 billion as a lot of wind capacity is built offshore, which both Labour and Conservatives are really keen on. So us at the moment, we produce about 1% of UK, 1.6% of UK electricity. We service about 1.8 million homes, and we avoid about 2 million tonnes of CO2 every year. So, reasonably sized player, but in a very big market that's likely to grow substantially.
So you currently have just under 50 UK wind farm assets. So when the income is being generated, how much of that income is inflation linked and how much does the trust benefit from rising power prices?
Yeah, so we designed the business with a sort of a strat plan of simple, low risk and transparent. So we're meant to be all of those things. So we only buy operating wind farms. That's pretty sort of straightforward what we are. But the income stream, because we have no fuel costs effectively, we don't have a lot of costs, so it's all about production and what we get paid for it. So wind volume is not particularly volatile year to year, so we will produce what we expect over the long term. But the prices that we get for each of those megawatt hours is obviously variable. Now half of the stack, if you like, is the with the vast majority of the projects we have go under what's called the renewable obligation regime. So we get a certificate that's RPI linked. It's about £60 this year. It was £30 20 years ago. So that's a key component, if you like. And because of that stability of the production and also of that certificate, that means we can take exposure to the wholesale power price. So we have a limited exposure, if you like, to power prices. And the nice thing about that, I guess, is that it gives us enough return to be able to do all that reinvesting, if you like, and pay the dividend that increases with RPI. But it also, in the likes of last year when power prices were high, we got paid for it. And so on average about 50% of our revenue is explicitly linked to RPI because it's got a contract that increases with RPI, and then the other's power price, which it generally inputs into inflation into the basket, as we obviously saw we've been seeing over the last year.
And in terms of those cash flows, how do you split it between paying the dividend and also reinvesting? I assume that reinvesting is very important for your strategy, given that UK wind farm assets, they don't last forever.
It's the question that when we have half-year results in about 3 or 4 weeks' time, that we want to get out, because ultimately we feel for 9.5 years out of 10 years since listing, we've been trading at a premium. The last 6 months we haven't. And I think we probably realised is that people have been buying that dividend, but actually a key component, which we thought people understood, but they probably haven't, is that we're not just trying to cover a dividend. We've got a lot of reinvesting going on. At the end of last year, these are the numbers last time we've done it, and we'll calibrate in half-year results as well, we'd paid £785 million of dividends. We had also reinvested £653 million of extra cash flow. And so it's not just the dividend is covered, it's that we are designing reinvestment for that very reason. As time goes by, wind farms will get to the end of life, notionally 30 years, probably longer, but let's assume just 30 years. And actually we want a business that continues, that all that reinvestment goes into buying other wind farms. So I think for us that reinvestment part is really, really crucial. And actually the thing that I'm going to have to talk to at half-year results, and I'm just gagging, if you like, to do so because it's so important, is that the return on our business to investors is about 10%. Yes, the dividend yield might be 5 to 6, but actually with that reinvestment, there's a 10% return there, which actually is, even in the current environment that we've got high interest rates, it is a good return. And and the best comparison, if you like, is to an index-linked gilt, because our dividend and our NAV increases with RPI in the same way that an index-linked bond, the principal and the coupon, increase with RPI. So we're very similar in structure, and we trade 500 basis points north of that. And for the risk that we take, that's actually a very good return.
So the investment trust, it's been going for over 10 years and has a target of delivering dividend increases that are in line with RPI inflation. You've achieved this every single year since launch. Were there any years when achieving that target was difficult?
No, is a simple answer. Some years it's been tighter, some years it's been less tight. So the two lowest years, we had 2016 when we had 1.4 times cover, only 1.4 times cover. And that was, so the design is normally about 1.7. So 1.4 was because we had slightly low production, and that was the $29 a barrel oil price thing, if you like. So it was slightly low power price and slightly low production, and that was 1.4. And then in 2020, COVID effectively. And so we had, decent production, but power prices came off. As we saw lack of demand effectively in the first part of the year when people were at home into May, power prices were very, very low. And then as we've sort of gone through from the 1.3 in 2020, coming into 21, we saw power prices started to increase. Some of that was a bit of a coming out of COVID, and power prices can be quite volatile in one sense. And so as you come into 2021, there's a little bit of pent-up demand from stuff that's happening post-COVID, accelerating, so power prices go high, and so we were 1.9 covered in 21, and then we get to last year when we actually had relatively low production when we were 3.2 covered. So we've never been in the twos yet. We reckon this year we will be in the twos, i.e. 2 times covered. And actually at 3.2 times covered, that means we had 2.2 of reinvestment, which was about £360 million. Our IPO was £320 million, so we had more extra cash generated last year than the whole of our IPO. And yes, that says something about power prices last year, but it also says that we're also 15 times bigger. And then so we've grown from a relatively small company to something that can move the dial.
Going forward, how sustainable is the dividend? How sustainable is that RPI target of matching it?
Yeah.
So, in other words, how secure and predictable is the income that's being generated?
Very, I think, is a simple answer. So, wind volume, it is just diligence. It is what it's going to be. Not a risk, if you like. It's diligence. I think all of the politics of 10 years ago have come entirely in our favour. We see. I've had meetings in the last 6 months meetings. I've taken them around wind farmers in one occasion. Keir Starmer, Jonathan Reynolds, Jeremy Hunt. And stability of the regime is actually quite important. If you want to double the amount of capital in the sector over a 7 or 8 year period, stability of the regime is very, very, very important. And I think the political parties get that. And then the risk, I guess, is exposed to the power price. We want to be exposed to the power price. It was sort of beneficial last year. I think for us, one thing that we probably will put in a half-year account, so you've seen it here first, I guess, is that even if the power price over the next 5 years was zero, we could still pay that dividend. We wouldn't have a lot of reinvesting going on, but the dividend will be safe. And so I don't think people quite understand the cover is very, very strong. So power price is zero, still pay the dividend. Obviously, power prices can't be zero because none of the energy system would work at that point. People have to, for CCGTs, combined cycle gas turbines, they have to pay for gas. They have to pay for the carbon they use. So the power price can't be zero. But if it was, we're still covered. So
are there any threats at all, do you think, that could put your dividend aim under jeopardy? You've mentioned power prices, that you think the dividend will still be sustainable even if they declined. Is there anything left field that may happen?
I think you can never say never in terms of left field, but we scratch our heads to answer that question. Anything other than this is really stable, really safe. And it's why, to some extent, 500 basis points north of a gilt seems quite high. That why we're trading at a discount, probably more about the market and not too much to do with us. And it's why the message I need to get across at the half-year results is this is all about return, the fact that we decide to pay a particular dividend is kind of arbitrary. We could pay a higher dividend and maybe the share price would go up and we'd have less reinvesting, and that would be illogical. But actually, we could do that. And so the argument about return, hugely important.
And how about political risk? I mean, there's windfall taxes were introduced, and in the future, the windfall taxes could go up even further.
Yeah, so we're not going to pay a lot of windfall tax. Power prices have come off slightly since last year. We'll pay a bit this year, probably not so much next year. I think investors, when we were talking to them last year, we were involved in conversations with government and other chief executives of major utilities. We were doing those conversations throughout the year. I think government understood that, and investors understood that Ukraine was quite a thing, I guess, and they obviously drove power prices up. You could see that in terms of power price expectations in 2022, 2023 and beyond. In March, when Vladimir Putin went into the Donbass, you saw the expectation for power prices go up substantially. Obviously, people thought the supply goes down and therefore the costs go up, etc. The world has changed a little bit since then, and we see, there is, exposure to that, but we're not particularly expecting that to move too much. And the most important thing for us is we're meant to be straightforward and low risk, and so even if they move around a lot, we're still capable of doing all the stuff that we want to do. In terms of politics, though, in terms of the UK, yes, there's the sort of Russian geopolitical stuff, but in terms of the UK, I think it's been a bit of a wake-up call, and so politics is very much behind needing a homegrown industry, and the stability of that, and it's based here, and we know where it is. I think that's sort of kind of important. I think in the longer term, you can't have 100% renewable capacity. It's not possible, because you will have times, and wind is the big player, obviously, where you don't have wind volume. High pressure in the winter, it's cold, you don't have wind volume, and so you either need storage. Now batteries they're probably not the answer, because they're very, very expensive, and you would need to cope with those sort of 2 weeks, potentially very high pressure and low temperatures. You would need so much battery storage capacity that it'd be so expensive to do that. So actually the more relevant thing we think in the long term is electrolysis of hydrogen. If you do that becomes storage itself, if you like, and then you can burn that again. And so getting that to work is actually very helpful for the country, and the benefit, I guess, is that you can use excess wind volume to do that. And so hydrogen electrolysis in one sense becomes a bit like a battery, if that makes sense. And so in the long term, getting hydrogen to work is hugely important for the country. And I think that you see governments trying to encourage investment in that sector. And actually at Schroders Greencoat, we're doing that as well. We're trying to work out we have a separate private market energy transition fund, and that is a business that will work out how to do some of that stuff as well. It's not related to UK Wind in one sense, but it's all the sort of know-how we have in the building. We're doing things like that.
Stephen, thank you for your time today.
Thank you.
That's it for this episode of our Insider interview series. You can check out the rest of the series on our YouTube channel, where you can like, comment and subscribe. Hopefully, see you next time.